Banks borrow, lend, and earn the spread. This spread comes from the difference between the earnings on assets and the cost of funding. For this to work out, earnings have to actually arrive. Borrowers have to repay their loans. This is what credit risk is all about. In this session, we are going to more precisely define credit risk. We will then discuss how banks and other financial institutions measure credit risk. In a final step, we will look at the various tools that banks use to manage credit risk. On the asset side of the balance sheet, banks grant loans or purchase bonds. These assets typically have long maturities. This means that banks will expect to receive payments of interest and principal over the course of many months and many years. If all goes to plan, the bank will receive every single one of those payments. This is the most likely outcome. However, there is some downside risk. Some borrowers might miss one or more payments. We call this event default. This is typically a low probability event. Default can force a borrower into bankruptcy, which can be very costly, so borrowers want to avoid this outcome. Nevertheless, when default occurs, it is harmful for the bank. Earnings will fall, as will the value of the bank's asset portfolio. The effects of credit risk can be seen in this chart. Here we have the charge-off rate for bank loans over the past 25 years or so. Loans that are not repaid must be removed or charged off the bank's balance sheet. Credit cards, business loans, mortgages. People need to live in their homes, so we see that mortgages tend to have the lowest default rates. Credit cards are unsecured and easy to ignore. As a result, credit cards tend to have higher default rates on average. We see that there is a strong business cycle component to all of these products. During economic recessions, households and businesses all tend to do poorly at the same time. This is called systematic credit risk. Here are the credit risk exposures at JP Morgan Chase in 2019 and 2020. Let's focus on the biggest exposures. In the balance sheet, we have loans. Some borrowers may miss a payment and transition into the non-performing bucket. Non-performing loans haven't died yet, but they are in trouble. Down here, we can see about 0.5% of the loan portfolio was charged off in 2020. The bank also has off-balance sheet exposures. Loan commitments are contingent assets. These include credit cards. Borrowers might draw down on these commitments. As we saw, credit cards have high default risk, and so JP Morgan is required to disclose these exposures. What do banks do about credit risk? Well, they measure it and they manage it. The measurement part is often called credit risk analysis. Economists also like to call this borrower screening. Credit risk measurement happens at the front end when a borrower is applying for a loan. Lenders spend resources to generate and process information about potential borrowers. The input will be borrower data. A loan officer may collect a paper or an online application from a potential borrower. This may contain information about the borrower's income, wealth, age, and occupation. A credit bureau may provide data on borrowers' outstanding debt and previous repayment behavior. In the 21st century, there are endless options when it comes to alternative data. You can access spending data, internet browser histories, location data, even information about social networks. What if you are Facebook friends with people that often default? The ethics of these alternative data are currently being debated. Some or all of this data will be plugged into the lender's credit risk model. These models take a variety of forms. They can be qualitative and follow a series of questions about the borrower's specific circumstances. Why is the customer borrowing? What does the borrower need? How will the borrower repay? Can the lender be protected in some way? We also have statistical models that sort borrowers into risk categories based on observable characteristics. These models can range from simple regression analyses to the application of cutting-edge machine learning methods. These models always use data from past borrowers to predict the performance of our current applicant. The specifics of these models is super interesting, but it's beyond the scope of our current discussion. Regardless of the model, the output will be a credit rating. This credit rating corresponds to a probability of default. Corporations have credit ratings. A business might have a credit rating just at the investment grade cutoff. That would be a BBB rating. This means that the business has a 0.2% probability of default. Individuals, well, that's us, we have credit ratings too. In fact, not having a credit rating is usually a very bad signal. Here is the FICO rating system. Scores run from 300 to 850. Higher scores correspond to a lower probability of default for a household. These scores are estimated by a private business, the Fair Isaac Corporation, hence FICO. They take data on our credit cards, car loans, mortgages, student debt, and whether we pay our bills on time. The information is processed into our FICO score using their proprietary default prediction model. Let's assume that we can measure credit risk. We have a loan applicant and we have a credit rating. Then what should we do? The first thing to note is that defaults will happen. They are an inevitable part of the lending business. The goal of any lender is to be compensated and protected. We can see this with the design of loan contracts. Let's say our credit rating is above the bar and we want to make a loan. We can use our credit rating to price the loan. Riskier borrowers are more likely to default, so we should set a higher interest rate. The lender should be compensated for potential credit losses. Lenders may also include performance-related clauses into loan contracts. These are called covenants. Covenants restrict or encourage certain behaviors that reduce the probability of default. For example, a covenant could limit the amount of new debt that a business borrower can issue. When covenants are violated, borrowers are required to report to the lender. Hopefully, the problem can be resolved before things get worse. For example, the borrower and lender could renegotiate the loan. This is usually called a workout. Here is JP Morgan's Customer Assistance Program in its consumer loan portfolio in 2020. Due to the COVID-19 pandemic, many customers were struggling with debt repayments. This included about $10 billion of mortgages. From a legal standpoint, JP Morgan could demand the immediate repayment of these loans. However, if the goal is to minimize losses, then offering some forgiveness in the short term may be more prudent. In many cases, JP Morgan offered to defer these missed payments until the end of the loan term. With mortgages, we can see that about 95% of borrowers subsequently got back on track. The final element of contract design is the security or priority structure. When a loan is secured, it is backed by an asset that the lender can claim in the event of default. When a loan is senior, it has the first claim on the assets of the borrower. Having a senior and secured claim reduces losses in the event of default. This is evident when we look at the recovery rates by the type of debt. The recovery rate measures how many cents on the dollar is clawed back when a business files for bankruptcy. This data is from 1983 until 2017. It is collected by Moody's, which is one of the bigger credit rating agencies. Default is bad news. Everyone loses out. However, we can see that the senior secured claims recover more than the junior claims. Diversification is the most basic tool that banks can use for protection. Banks will invest in a variety of assets across products, locations, and industries. Diversification across assets will not eliminate credit risk, but it may limit the chances of very bad outcomes in the asset portfolio. For a given desired return, it is possible to choose a combination of investments that reduces risk to a minimum feasible level. To further reduce credit risks, banks have two more options. The first is loan sales. If credit risk is too high, then banks can simply choose to sell the loan. The loan is gone, and so is the credit risk. This can happen at the time of origination or afterwards. This can be a whole loan sale or a partial sale through loan syndication. We have discussed syndication in the past. This is common for large corporate or commercial real estate loans that carry a lot of risk. When banks originate and distribute loans, they lose out on some or all of the interest income. They collect upfront fees instead. The final option is to use credit derivatives. These derivatives act a lot like insurance against borrower default. Credit default swaps, or CDS, are the most common example. For a fee, a bank can buy a CDS on a loan. This derivative may pay out whenever the loan defaults. The bank gives up some profit from the loan, but no longer has to worry about default. Let's wrap up. This time we introduce the concept of credit risk. This is the risk that loans will not get repaid on time and in full. Credit risk models take in borrower data and spit out a credit rating. The credit rating corresponds to a probability of default. Lenders can protect themselves against credit risk through carefully designed contracts, diversification, and if that's not quite enough, then they can offset risk by selling loans or using derivatives.